everybody, Nate here. So the Federal Reserve has reached a consensus. Starting in May, they're going to allow $95 billion of their $9 trillion balance sheet to run off starting in May. This is going to be around $60 billion in treasury bonds and around $35 billion in mortgage-backed securities. This balance sheet runoff is around 2 times faster than we saw back in 2017 and 2019. The Federal Reserve has also racked up twice as much though, so that makes sense. In addition, the Federal Reserve talked about raising its benchmark interest rates a lot faster and a lot more aggressively than they did back in their last meeting. Now, they haven't actually said whether we are for sure going to have a 50-point basis hike in May, but they pretty much pointed to that during their last summary. Basically, the only reason why we didn't see a 50 basis point hike back in March is because of the war in Ukraine. Our economy was pretty fragile. There was a lot of supply chain issues and inflation was raging, so they couldn't exactly raise interest rates as quickly as they wanted to. So they took a more measured approach and only raised interest rates by around 25 basis points. Even though a good portion of the Federal Reserve believed that we needed a 50 basis point hike back in March. That leads me to believe that the Federal Reserve knows that our economy isn't doing as well as they think it is. The only difference now is they're being a little more open about it. So overall, looks like the entire Federal Reserve is on board right now and on the same page about raising interest rates and fighting inflation in 2022. Now, I'm going to be completely honest with you. This is nothing new from the Federal Reserve. They have been saying that they wanted to get aggressive with inflation for a long time, but they don't want to tank our economy in the process. The fact of the matter is, if the Federal Reserve raises rates too quickly and pulls a lot of its economic stimulus right away, then that could lead to an economic collapse. Now, Americans are facing super high interest rates and super high inflation all at the same time. That creates a situation called stagflation. Your economy goes in this direction and inflation goes in that direction. So the bad one is going up and your economy growth is going down. Two Fed presidents in particular, Harker and Bernard, have been talking a lot recently about getting aggressive with inflation. Well, does that mean the Federal Reserve is finally going to do something about inflation? Well, before I get into all of that, do me a quick favor and hit smash or destroy that thumbs up button below and ring that notification bell too. Both of those two things are completely free and they help to show me that you like this video and that you want to see even more just like it. Harker said specifically that he expects, quote, a series of deliberate methodical hikes as the year continues and the data evolves. In addition, Harker said, quote, bottom line is that generous fiscal policies, supply chain disruptions, and accommodative monetary policy have pushed inflation far higher than I and many of my colleagues in the Federal Reserve are comfortable with right now. I'm also worried that inflation expectations could become unmoored. And Bernard kind of echoed this in a press conference just a few days ago saying, quote, most Americans, most people, most businesses, hopefully people in tribal nations, you all have confidence that we're not going to let this go forever. But if you don't have that confidence, let me give it to you now. The Federal Reserve President of San Francisco went on to say, quote, raising rates is what is necessary to ensure that, again, you go to bed at night. You're not worrying about whether prices will go higher, considerably higher tomorrow. Currently, inflation is much too high and is subject to upside risks. The committee is prepared to take stronger action if indicators of inflation and inflation expectations indicate that such actions are warranted. And recently, Chairman Jerome Powell of the Federal Reserve has said the exact same thing. They are willing to do what it takes to bring inflation down. So that's the basic bulk of what the Federal Reserve said in its meeting summary. Their hope and their plan is to raise interest rates by 50 basis points in May, but only if the economy looks like it can handle it. In addition, they're going to start letting that balance sheet run off, starting at $95 billion every single month. So that is going to take a very long time. Like I said, their balance sheet is around $9 trillion. So as the economy starts to recover even more, they can hopefully start to bring that back a lot now too. Like I said before, this is nothing new from the Federal Reserve. They have been saying that they've wanted to raise interest rates and run off their balance sheet for a very long time now, as early as November 2020. 2021. And the reason they've been giving so much time in between actually doing something is because they want the American people and the stock market, more importantly, to prepare themselves. This type of rate increase has a massive effect on our economy in general. Like take the housing market for instance. Raising interest rates just a little bit from the Federal Reserve means that millions of Americans are no longer going to be able to afford a home anymore. That means debt in general is going to be hard to come by. You can't exactly get a mortgage loan or an auto loan or a personal loan if interest rates are super high. What that ultimately means for Americans is as inflation goes up, it's going to be a lot harder to pay your bills. Not only are grocery prices going up, but you can't exactly get a loan to bail yourself out if you really need that. And for businesses on the New York Stock Exchange, well, with interest rates going up and that balance sheet running off, there's going to be a lot less money circulating around. In 2020 and in 2021, it was super easy for corporations and companies to make risky bets because they were betting with Uncle Sam's money and not their own dollars. So even if they failed, they didn't really fail at all because they didn't lose any of their own money. For banks in particular, they're going to have a lot less money to lend out because some of this money was in mortgage-backed securities. We're talking hundreds of billions of dollars every single month that the Federal Reserve was investing. The rest was going into treasury bonds. So banks now have less money that they're going to be able to lend out. But in my opinion, these corporations and these banks still have a ton of cash to play with. This is because of all of the financial stimulus that was given out in 2020 and in 2021. Banks and financial institutions got a lot of that, and the Fed's balance sheet reached $9 trillion. So the stock market still has a lot of residual value. So if all of that is true, then why exactly did the stock market essentially go way down right after the Federal Reserve made this announcement? Well, the first thing you got to keep in mind here is the stock market is extremely emotional. If they feel like they're going to start losing a lot of money very quickly, then investors want to get out. Nobody wants to lose money, and the people who are losing the most money are your short-term traders and your big institutional investors. You know, the people that literally invest for a living. If they start to see the writing on the wall and they don't want to lose a lot of money right now, then yeah, the stock market is going to go down, and they know this, and they're basically having what's known as a taper tantrum right now. We saw this happen after the 2008 financial crash as well. The Federal Reserve entered the market, they started pumping trillions of dollars into the New York Stock Exchange, but eventually all of that stimulus ran out and the stock market was extremely upset. I mean, you'd be upset too if somebody started to pull thousands of dollars from your bank account saying that you can't use that money anymore. I mean, yeah, the stock market wants to be risky, and this is exactly why we saw the yield curve essentially invert after the Federal Reserve made this announcement. The 10-year yield basically shows the direction our economy is taking. If people are choosing to invest more in treasury bonds, then that can show that there's a lot less risky investors and people that want to be risky in our economy. Investing in treasury bonds essentially means that you're investing with the United States government. You give the federal government a certain amount of money, and then they pay you back with interest over time. And it's not that risky because the United States federal government is going to be around for a long time. That ultimately means there is less money for the stock market, and there's less money for all of your big businesses and corporations. In addition, they're afraid that all of this tightening from the Federal Reserve will ultimately mean that Americans spend less. And if Americans are spending less, whether it be on a mortgage or just on basic goods and services, well then now all of your businesses and companies are making less in profits and revenue. So yeah, there's going to be a period in the United States where all of these companies start to shrink a little bit for the short term. And there's going to be some slight shrinking in the housing market as less people just have a lot less money. But you gotta remember too, the United States economy is not super healthy right now. We have had a lot of stimulus and a lot of money printing over the last 2 years that has overinflated just about everything that you can see. And I'm not saying that we're going to run into a recession right now. It really just depends on how aggressive the Fed gets and how bad inflation gets in our economy. What I'm saying is that these companies and corporations and markets, yeah, are probably going to shrink for a little while, but this is only because they've been so highly elevated plummeted over the last 2 or 3 years. They now need to come back down to normal levels so our economy can start functioning at a normal level too. And honestly, these banks and financial institutions have nothing to worry about. They have way more money than they need. Expenses for companies have gone up due to inflation. They've had to make a lot more in order to meet demand. But the biggest expense for companies, wages, are not going up nearly fast enough right now. So profits are still going to be high, and people, when we talk about the housing market, are still going to buy homes in the United States. You're not going to see an outright crash because demand is still so high. And as we start to see wages improve in the US, well, then the housing market is going to go up, and interest rates are only going to bring prices down. Granted, it is going to be harder for everyday Americans because inflation is rising, and there's going to be a delay in what the Federal Reserve does and inflation in the United States. We can still expect inflation to go up for a good period of time, because even when the Federal Reserve does raise its benchmark interest rates, well, it's going to take a little bit of time for banks and financial institutions to actually see the results from that. And once they start seeing the results, it's going to take a little bit more time for the everyday American to see results. So basically, the Federal Reserve knows we're going to see a shrinking in our economy. They don't think at this point it's going to cause a recession because our economy is just healthy enough to take these rate hikes and all of these balance sheet runoffs. The stock market, though, is built for profits. So when you see the stock market go down over the next month, when the Federal Reserve announces that they're going to raise their benchmark interest rates by 50 basis points or more, then that is something to totally expect, because the stock market doesn't want to lose any profits. If you have a company that is extremely good and they suddenly drop a little bit of revenue for 1 quarter, well, that entire company's stock will tank. And depending on which company it is, the stock market could tank as well. Every single quarter and every single day, the stock market and the companies on the stock market want to make more money, even if it doesn't make any sense to and is fundamentally against what is happening in our country right now. So that's what you've got to keep in mind here, that the stock market is looking to make money, and if it starts to lose money, then people are going to pull out and they're going to put their money into other things. They don't want to have any sort of buffer mode. And the other thing to keep in mind here is the stock market, no matter how many times it has dropped in its history, has always gone back up. This is because fundamentally there's nothing really wrong with the market. It's the mindset of the investors and the companies in general. But now I want to hear from you on this issue. What do you think about the Federal Reserve's recent minutes summary? Do you think the Federal Reserve is actually going to do what it says and get aggressive with inflation during its next meeting in May, raising its benchmark interest rates by 50 basis points or more? Or do you think the Federal Reserve is going to take a more even-tempered approach and only do a 25 basis point hike, allowing inflation to go up just slightly, but also keeping it at a controlled level so that our economy doesn't tank? Whatever your thoughts are, leave a comment below before you go. But that is it for today's business and financial news breakdown. Thank you so much for watching. If you want to stay up to date with all of the top business and financial news from around the country, our team puts together a free daily newsletter, and you can subscribe to it by clicking the link in this corner right here. And if you want to stay up to date with me and everything else happening in the business and financial world, I'm putting out updates 7 days a week over here on this channel, and I've actually got another one ready for you right here, so be sure to check that out before you go. That is it for me, everybody. Be kind out there, and I'll see you all in the next one.